Investing can be incredibly complex at times, especially if you don't know where to start investing and where to put your hard-earned money. But sometimes it can come down to just one simple number. That is the 52-week high. But exactly what is it? How does it work? Why does it work? And I got a bonus for you. What are the best stocks at or near the 52-week high right now that you should consider investing in? Let's go ahead and break it down. Now, right now, somebody's out there cutting down trees, being a lumberjack or whatever. It may or may not pick up on the microphone, so it is what it is. I'm recording, all right? So let's just go and jump right into it. What is the 52-week high? Why is it important? Is this. I kind of boil this in and have been teaching about this for a while, but every time I talk about stock, I say how well it has done in the last 6 months and in the last year. There are 52 weeks in a year. There you go. All right. But most importantly, anything that I try and teach about, I try and have some data, some research behind it. And there is a study from the University of Houston that says that the 52-week high is a good indicator of future success. Now, is it a guarantee? No, it is a, quote, good indicator. All right. Now, why is it a good indicator? Exactly how does it work and where can you find it? Number one, you can find it by going to almost any investing app. It'll show you a chart that's something like this, usually a gauge that shows you that, hey, it is closer to its 52-week high or it is closer to its 52-week low. Now, it works on something called the anchoring bias, which means this. If a stock is doing well, we are anchored to think that, hey, it's near its 52-week high and two things are going to happen. Number one, you are anchored to think that this stock is good and is going to continue to do so. Proof. You think that Nvidia is a good stock and is going to continue to go on that path forever and ever until something very, very terrible happens, a recession, so on and so forth. And I think that too. I think that Dollar General is a terrible bottom of the bargain or bottom of the bin stock and is going to continue to be there until something catastrophic or very good happens to it. Right, catastrophic means something crazy happens to turn that stock around. That's just, it is what it is, right? We are anchored in that particular belief. Well, there's also, that's number one, there's also a belief of this. And I know somebody is likely typing this in the comments right now. Don't stop, go on and finish that comment. Finish that thought while you at it. Is this. There are people who say, well, it's at its 52-week high. I don't know if I want to buy it. It feels too expensive. That limiting belief that you have is exactly why these stocks are worth buying. That is because traders, right? People who think like, oh, if it hits this 52-week high, I don't want to push it over because I feel like that is a ceiling. There is no ceiling to the stock market. And there's nothing stopping it from going to whatever that next level is. 52-week highs are printed every day. Just like the stock market as a whole, we hit multiple all-time highs. We hit all-time highs for the stock market last year, like over 30 times, probably well over that particular amount, right? So what happens is traders will say, I don't want to hit the 52-week high, even though it's good news, I'm just going to not do anything. The rest of us, investors who are long-term, as well as institutional investors, the 401ks, Fidelities, the BlackRocks, they keep investing and the stock continues to go forward. If the stock was already doing well and traders stay still and the stock continues to go forward, what does that mean? It just moves forward. It continues to do well. It carries on the momentum and hits another and another and another 52-week high. It moves on the path that it was already going. That is how it works. And it works the exact same way with the 52-week low in the opposite direction, like something with a Dollar General. We see it going down and traders say, I don't want to buy that. And nobody buys it and it just continues to fall. And that's kind of how this whole thing works. Traders don't want to push it forward, but investors, other investors, institutional investors just continue to press it on its way. And then you see something is anchored at the bottom and we just say, ugh, look at that, and continue to let it fall. And that is the simplest version of how it works. You're more than welcome to read the entire study if you wish. So, given that, what are the downsides? What you don't want to do is just look up 52-week highs of every stock and just go out there and buy it, okay? There are things like bad news changes to CEOs, right, and things that can change how a stock performs, as Chipotle, how that went, right? So there are some things, research that you want to add into your process to determine whether or not this is going to work for every single stock. But here are some that you should consider for your portfolio right now. Take-Two Interactive, and these are all stocks, most stocks that we have not mentioned, and there is a bit of a secret here as well. So Take-Two Interactive, TTWO, up 31% in the last 6 months, up 38% in last year. All of these stocks that I'm going to mention at the time that we are recording are at or near their all-time high, usually within 10% or so of their all-time high, if they're not at the time, again, that we are recording. They're a video game company in the tech video game space. I haven't talked about them probably since the pandemic, though I wouldn't consider them a pandemic stock. They on their way up, obviously, and I think they might be one worth considering. Now, these next two, there are two here that are in the finance space. I've told you about my confidence in the finance space, but Morgan Stanley, they up here again. Up 27% in the last 6 months, up 50% in the last year. I don't sleep on the finance space. You don't have to invest in Morgan Stanley. I don't currently own Morgan Stanley. I already have a few finance stocks, but I'm telling you, you might want to have one or two in your pocket, one or two in your portfolio. Don't sleep on it. All right. Next here is Cisco. Cisco is making a comeback. They had some rocky times, but right now near a 52-week high, and also up 26% in the last 6 months, and up 31%. Let me give you a quick pause here. With the 52-week high strategy, there's one other mistake that investors tend to make. A stock can have a 52-week high. It doesn't mean it's beating the stock market. Keep that in mind. A stock can have a 52-week high. It does not mean it's beating the stock market. So it's just like, let's say you have a career high in basketball and you scored all these points. You just scored 5. That doesn't mean you won the game. Okay, so you can have a great game. It doesn't mean that you were the best scorer on your entire team or that you even won. So that is another mistake that investors tend to make too. Context is important here. So not only did these stocks beat the S&P 500, they're also at a 52-week high, and they're also doing well just generally. So that is something that I meant to mention at the top. That's why you want to watch the whole video and not just, skip through merrily without understanding everything. Visa is one. I think someone asked me about Visa last week, if not yesterday. The day's been together. Visa stock symbol was just V. They're an OG. A lot of letters there. But Visa is doing quite well. I think they're quite understated, but up 30% in the last 6 months, if I wrote that down correctly. If I didn't, I'll correct it here. But Visa is up. I know for a fact they're up about 23% in the last year. Obviously, this will fluctuate depending on the time that you are watching this. Now, here's where things get a bit interesting. I will go into greater detail in our members only about the set of 4 stocks I'm about to cover next. eBay. I forget that eBay is a public company. Now, they were with PayPal. They split with PayPal. PayPal has been iffy and strange. We can get into that at a later time, but eBay is up 20% in the last 6 months and up 61% in the last year. Very, very understated, very quiet, hush hush, right? eBay's been absolutely taking off. It might be one to really consider. Especially given some other things that are happening in the market. We'll talk about that more in our members only. Kroger. That one is up 24% in the last 6 months and up 33% in the last year. Now, Kroger was, I think it was Albertsons that they were doing a potential merger with that was actually blocked by a judge not too long ago. That appears not to have hurt the stock, at least currently. That is something I would keep an eye on. I would also keep an eye on whether or not this will have an impact with tariffs. In theory, they would be able to raise their prices just like a Walmart and just like a Costco, if that is the case. I don't know, right? And because there are more in groceries than tech and other things that they might sell, how bad of an impact would it be? I don't know, right? That is a question that I would have, because Kroger, in my mind, would be more impacted by like the price of avocados, which right now don't have a tariff, but what other groceries could be impacted, right? That's something that I would dig into if I'm investing in something like Kroger. And then you have T-Mobile. T-Mobile, another stock that's very understated that I don't think enough people are talking about at all, up 34% in the last 6 months and up 61% in the last year. If you want some stock that you should absolutely avoid, especially in a time like this, you want to check out this video right here.